Hello, everyone. Josh Morin here with Infinite Financial. Welcome to part one of our Infinite Banking Masterclass. This is a deep dive training series built for agents who want to master participating whole life insurance and truly understand how the infinite banking concept works from the ground up. Now, this is the entire reason that I got my life insurance producer's license, and I'm excited to be able to deliver on this topic. If you're watching this, you've probably heard the buzzwords across social media, and especially if you've been in the space for some time, you've heard words like become your own bank, cash value life insurance, tax free retirement, maybe even money multiplier, the Rockefeller method, the waterfall method, so on and so forth. But what most people, and let's be honest, most agents, they don't have is a complete strategic understanding of what this product actually is, how it works, and why it belongs in a client's financial plan. That's what this series is all about. This isn't a surface level content here. I'm not going to deliver anything that's surface level. This is your blueprint, part high level strategy, part boots on the ground execution for understanding, presenting, and delivering one of the most powerful tools I feel and misunderstood financial tools available today. And everything starts with the foundation. Let's start by clearing up a massive misconception. Participating whole life insurance is not just life insurance. Yes, it provides death benefit, but that's not what we use it for when it comes to infinite banking. Especially if you are used to simplified whole life or final expense, most of those products only go to 50 or 100,000 in death benefit coverage. It's instant issue. That's not what we're working with here. This is a contractual savings vehicle, one that's designed for long-term capital efficiency, not just for coverage. And when we structure these types of plans and policies properly, a participating whole life policy functions more like a guaranteed tax advantage liquid asset class. It's like a private reserve system slash insurance policy. So I'd look at it behaving more like a private reserve system more than it would be insurance policy. The insurance is just an added benefit. Here's what's guaranteed in a participating whole life contract. Not the elephant in the room. It is life insurance. So you get a guaranteed death benefit coverage. You also have guaranteed level premiums. So you don't have to worry about those premiums moving up on you as you get older. You also get guaranteed annual cash value growth. And then where the infinite banking concept comes to life is a guaranteed right to borrow against that cash value. And then on top of that, on top of all those benefits and features, policy is eligible to participate in the company profits. So that's why we have participating whole life policies. So it's eligible to participate in the profits of the insurance company through annual non-guaranteed dividends. This is where that participating part comes in. So what are we really working with here? We're using a product that earns compound interest every year. It's going to grow uninterrupted. It's not tied to any market performance. It's not taxed as it grows, and it can be accessed without triggering a taxable event. That's really the opposite of traditional investment accounts because this type of plan is privately owned, has tax favored capital base that the client controls, and it compounds every single year guaranteed. Let's pause and address the elephant in the room because unlike participating whole life being insurance coming with the death benefit, this actually is the elephant in the room. So why whole life and not index universal life? I don't want to have a fist fight with IUL and whole life infinite banking practitioners out there because I am definitely product agnostic and more in the middle than picking a side. The reason that we use participating whole life is because infinite banking is about controlling guarantees. It's not about chasing upside or betting on index performances. So with IULs, growth is tied to the market. Yes, there's a floor to protect against losses, but there's also a cap, a participation rate, or a spread that limits gains that introduces the word variability. Yes, I know it's a little bit more conservative and vanilla than other variable classes, and it does suit some needs on terms of fixed portion of your portfolio, but it's not what we use for infinite banking. The bigger problem here is the cost of insurance in an IUL increases every year as a client ages. If you didn't know this, an IUL is built on the chassis of UL, Universal Life, which essentially is a 1-year renewable term policy. So it's a term policy that renews every single year until 121. Now, I'll be doing a video series breaking down the ins and outs of IUL and the use cases that we have or suggest for our clients at Infinite Financial. But for now, I'll keep it simple. That rising cost in insurance long term can eat into cash value, especially in the later years, even if the policy appears to be performing well early on. Now, there are some ways to mitigate against this later on in making policy changes, but we'll save that for another time. Now, with whole life, everything is fixed. So you don't have to worry about that big V word variability. The cost of insurance is level and guaranteed. The cash value grows every single year, guaranteed, and the client doesn't have to lose sleep over the market dips or rising internal charges, costs, or fees. So, if we're building a personal banking system, something designed for long term liquidity, control, and predictability, we don't want variables. We want something highly predictable. We want to eliminate as many variables as possible. So that's why we want those guarantees. And that's why we use participating whole life insurance. Now let's talk about who we place these policies with because the insurance company absolutely matters. Now, this isn't your farmer's insurance company that your brother in law is pitching you at the barbecue. We only write with mutual insurance companies. Why? Because mutual insurance companies are owned by their policyholders, not stockholders. So that means that their primary responsibility is to the client, not to the shareholders or quarterly earning reports. So if you work with a stock company, you're going to be subject to a lot of variability. There's a lot of risk sometimes associated with those types of companies. And you also want to ensure when you partner with a mutual insurance company that they have a long history of being a mutual insurance company, at least 100 years old. The reason being is there are some mutual insurance companies that have demutualized and become a stock company. So none of our clients are ever exposed to that risk of a mutual company that we're working with becoming a stock company. Now, when we use a mutual company, this translates to conservative long-term investment decisions, large, stable cash reserves. So these companies are very solvent. So unlike the banking structure that requires 0% of the money that they're loaning to you on reserves, these insurance companies have high solvency, typically 1-to-1 ratio. So for every $1 that's loaned or leveraged, they have one in reserve. So high solvency ratios. They also have a focus on stability and sustainability over time. Like that is their main focus, long-term sustainability. And most importantly, these companies have paid dividends every single year for over a century. I'm talking like 120 plus years in a row, sometimes more, through world wars, recessions, the Great Depression, inflation, financial crisis, currency changes, you name it. They've paid a dividend to their policyholders every single year. So here are a few companies that we like to work with at Infinite Financial Solutions. Lafayette Life Insurance is who I have my personal policy through them. I love them. Now there are some, I want to say pitfalls, but for my higher net worth clients that want to put seven figures in per year or more, I typically wouldn't choose them because they have some restrictions on paid up additions. Penn Mutual is a company that we don't work with, but they're a great company. Mass Mutual, One America, and one of my favorites for my high net worth clientele is going to be Emeritus. All of them have A or A better ratings and over 100 years of dividend history. So we're just talking about paying that dividend every single year as a mutual company. These are the type of companies that have done exactly that. Now, as an agent, that's the kind of foundation that you want when building a long-term strategy for your clients. Because when your clients get their annual statement and sees their cash value has grown every year, their death benefit increased, and they didn't have to do anything differently, we're talking a hands-off approach. That's going to build trust, retention, and long-term relationships. Now let's break down the structure, the core moving parts of a participating whole life policy. First is going to be the premium. I'm sure you can understand what this is. This is what the client pays, which whether it be monthly, quarterly, annually. In whole life, the base premium is level for life. There's going to be no surprises or no increases. The second thing, yes, it's a death benefit. So you're going to receive a tax-free death benefit, which is the face value of the policy that's going to guarantee that payout to the beneficiary when the insured passes away, of course. The third thing is going to be cash value. This is the living benefits, the real power of the policy here. This is what grows every single year and the client can borrow against through policy loans. It's safe, compounding capital, and it's always accessible. Number four was going to be the dividends. Now, these are non-guaranteed annual profits paid by the insurance company. And when used correctly, we reinvest dividends into paid up additions, which I'll refer to as PUAs for short, which can increase both the cash value as well as the death benefit. Now, we'll break down PUA riders, MEC limits, and premium blending in part 2 of this series. But for now, just understand when properly structured, all these components work in sync to create a policy that behaves more like a private banking system than traditional insurance. Remember, I was talking about a private banking reserve than insurance? That's exactly what I mean here. Let's zoom out again. Why do we use participating whole life for infinite banking and not a Roth IRA, savings account, or 401k? Well, because this product is privately owned. It's creditor protected in many states. It's also not reported as an asset on fast forward financial aid. So if you're a parent that's got kids that are getting ready for school or college, or you want to put them in school or college one day, is you don't have to worry about this asset class being calculated in their fast forward how much they can receive for that financial aid. It's also tax advantage It's liquid and collateralized and uninterrupted in its compounding. It's also not subject to the 59.5 rule. So traditional accounts like IRAs, 401ks, things of that nature, there's a 10% penalty attached to early withdrawals before 59.5. It's also not subject to required minimum distributions, market volatility, third party custodians and people managing these things and high fees and things of that nature, as well as government imposed access limits. It's the only asset class that combines guarantees, tax deferral, uninterrupted compounding, and full liquidity all inside a private contract based system. And that's why this product matters, not just for your clients, but for you as the advisor, the agent. You want something when you provide to your clients that you could feel really good about. When you offer someone access to their own capital on demand without penalty, without taxes, and without market risk, you're giving them a tool that no bank, no 401k, and no Wall Street portfolio can match. In the next video, we're going to take this foundation and go deeper into structure and design. We'll cover how to blend base premium and paid up additions, how to maximize liquidity while keeping the policy under the MEC limit, why non-direct recognition matters for policy loans, and how to design policies that perform in both year 1 and year 30. This is where the real strategy begins and where you learn to engineer policy design based on clients' goals, timelines, and capital flow. So take your time to review your notes, revisit this video as needed, and get ready to level up, because when you understand how to structure these policies correctly, oh, I'm getting excited already. You don't just sell life insurance. You build financial systems that create independence, liquidity, and legacy for life.